Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and welcome to another Tuesday Barometer Reading webcast. Today, we're going to be talking about the market risks. We've had a pullback in the market as of late, where we'll speak big picture and whether we think this is here to stay or if this is temporary, and how we are looking at market risks today. So joining me as always is David Burrows, our Chief Investment Strategist and President at Barometer Capital. And of course, we will welcome your questions at the tail end of the conversation. We're not going to focus on single name securities this afternoon just because of what's going on in the market. So please feel free to send me broader questions that you might have that you'd like David to speak with. I know we're going to speak about cryptocurrency. We're going to speak about David's thoughts on the Canadian dollar and how our portfolios are hedged. So if you have anything else you'd like to add, please email me at phastings@barometercapital.ca or send me a message via the Zoom chat. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hey, Pam, how are you?
We're great, thank you. Always a pleasure to see you and look forward to your insight today.
Great. Well, thanks everybody for joining. We're going to focus on big picture today. It's funny, the market, I think, over the last 6-7 days off the highs, S&P at worst point yesterday was down 5.4%, but you would think it was 20, the way that the press has been talking. Lots of concerns out there, as always, which frankly is a healthy thing. Lots of discussion about Evergrande in China and whether the potential default on their debt might have some kind of a wide-reaching impact and be kind of a Lehman moment. There's been discussion, ongoing about impact of Delta. There's been some few questions around the fringes on the Canadian election, which frankly has very little to do with the stock market. And all of the various economic data that we've been seeing over the last little while. I'm going to come at it sort of from a high level and talk about it through our lenses. And we're just going to ask the question, here we are in the middle of September, headed into or in the period seasonally where I think market's a little more tricky. Is this a major cause for concern? Is it less a cause for concern? What are the market signals telling us? And so we're going to take a run through those things. So just to kick off, as always, we look at these decisions through a lens that is a process that we've used now for about 30 years. And we're not trying to be everywhere. We're trying to target areas of strength. The tools that we use help us to identify areas of market leadership. That could be specific sectors or themes or geographic regions. And we focus our attention in areas where there is appetite, where people are putting money to work. We don't need to be everywhere. We look every day for signs of changing leadership, either old leadership receding or new leadership emerging, so that we can make sure that the portfolios stay positioned properly. And then frankly, there are some times when risks are elevated, when market behavior is not very healthy, that we want to have a significant cash weight. And we might be out of big parts of the market or have cash and dry powder sitting on the sidelines waiting for a better opportunity. So the lens I'm coming at this through is quite a tactical one. Our portfolios are living, breathing things, and they change over time, sometimes faster, sometimes slower. But we really are trying to go to where the puck is going and recognize change before it's obvious, hence the name Barometer. I'm going to start with equities just focus today because that's been sort of top of mind for folks. This is a very long-term picture of the Dow Industrials, and I've used a different chart over time, but I thought it might be useful just to look at this. When we start to say, from an asset class perspective, do we have a tailwind or not? And the most basic way of looking at things is there are long-term structural bull markets and there are long-term structural bear markets. I've marked out here in blue and in pink, and they go on for a long time. And they have lots of resets along the way, but a structural bull market goes on a long time. The bull market that started in 1952 and went through into 1966 was 4,477 days. So you can do the math. It's many, many years. And the market returned before dividends about 289% over that period. Then the market went through a long drought where it went from being overowned to ultimately underowned and unloved by the early 1980s, 5,900 days without making progress. That's a long time for people to wait if they're buy and hold investors. If people were tactical, they could certainly take advantage of 2 and 3 and 4 year rallies, but you had to step out of the way in the trouble. And then the bull market in the 1980s and 90s went on just about 6,200 calendar days. It's a long time, 18 years, and gave a return of a little over 1,180% before dividends. So the reason I put this up here is because people want to highlight how long the market has been doing well in between major corrections. And there are major corrections in bull market. This is the crash in 1987. But this bull market kicked off in 2013 in the US, much later in other countries coming out of long consolidations. And it's been going on about 3,200 days. So 3,200 days versus 6,100 days, this can go on for a long time. And there's a major risk in getting too bearish or trying to pick a top every time the market makes a wobble. Market's up 161% since this bull market began, which is great. It's nowhere near 1,100%, like in the 80s and 90s. Is nowhere near almost 300% in the 50s and 60s. So, let's just keep that in the backdrop. Okay. Now, I should put this chart up last time. This is seasonality in the S&P in September and October. So generally by the 15th of September, 15th trading day in September, market's having a more difficult time. Let's keep this in context. If we index to 100, we're at like 100.3, and the low end is like 99.5. So we're not talking about huge volatility, but there does tend to be some choppiness in September and October. So the question is, given some of the bounces and pullbacks over the last few days, is there something to read into it? Here's the S&P going back to the beginning of this sustained rally, started in November of last year, and we've been in this channel pretty consistently all the way along, with very small pullbacks along the way. And here's where we pulled back to yesterday. So at the worst point yesterday, we're down 5.6%, and that happened over about 10 trading days or 2 weeks. And of course, we bounced late in the day yesterday, and we sort of held in today. So one of the questions we've been asked is, should we be expecting something worse? Now, anything can happen. We can look at history as to what has tended to happen in various situations. We can look at indicators that we have. And of course, we're also always looking for things that don't make sense, given what we think we know, that help us to understand, really what might be happening out there. Now, there's been discussion all summer long of the major risks that this market faces. And in the last month, 8 major investment dealers have come out saying, we think that there's a real risk of a 10 to 20% correction. And I'm not saying that that's impossible, but I am saying when everybody's looking for something, generally that's not what happens, because consensus investing really doesn't tend to be the most successful. So let's look at it through our lenses. Now, when we come at things, we have a basic process that we use. And for many, they're very familiar. We try to address each of these 3 factors. We try to identify the asset classes that have a constructive backdrop. Where is there a tailwind? And that could be equities, fixed income, real estate, commodities, and so on. And then within those asset classes, we try to understand which sectors or themes have a tailwind, because of course, markets don't all act the same. Asset classes act differently at different points in time. Sectors and themes work well at different points in time. But 80% of return comes from getting to the asset class right and getting the sector weights right. 80% of return. 20% of return is aimed at finding the right securities within those sectors. So we come at it 3 ways. We have a top-down model, which I focus on, which takes all of the various areas and universes that we could focus in and try to drill down to those that have new net money getting put to work. So we take all of the major asset classes, all of the major geographic regions, each of the major sectors and themes. We put them through a series of tests looking for constructive behavior. And at any given time, there's a few that have a strong backdrop, and we want to focus our attention in those areas. Second area that we focused on is finding securities. And we take all of the publicly traded securities globally and put them through a series of tests, looking for those securities that are good getting better. Okay, we're never looking for broken getting fixed. We're looking for financial characteristics that show improvement and, in fact, acceleration, and price characteristics that would support that view, technical picture that is supportive. And we run that daily, and then they take the output and we put them through due diligence process to try and identify farm team members, things we'd like to own if they turn out to be in sectors that are seeing that new money getting put to work. And that's where our portfolio lives. Now, of course, I said earlier, the portfolio is a living, breathing thing, and we have to be clear as to when it's time to exit. Easy to make an investment, hard thing to know is when to sell. And so the third piece of our strategy is a disciplined selling strategy. And frankly, we use stop losses on all of our positions. When we put a position on, we'll start with a partial position. We only add if the position starts to work, and then we'll follow the position along with stop losses, which lets us stay in our winning positions as long as they work. And if they don't work or they stop working, they come out of the portfolio quickly and quietly. So this is all about reevaluating portfolio construction daily and reevaluating each individual position on a daily basis, both fundamentally and technically, to say, are these the 20 to 40 best securities that we could find given what we know in the present time? Okay, so through those lenses, let's talk just from the top-down perspective. Here's a basic premise. Over the course of a cycle in a healthy market, as you go through a decline, one by one securities sell off, the weakest first. And then by the end of a decline, the strongest securities are getting hit. If something isn't going down late in a decline, it's not a fluke. It's because despite all the bad news, people are so confident they're willing to hold these securities despite a tough environment. When the most aggressive folks start putting money to work, the strongest securities start to rally first, often before the market makes a low. And as that continues and the market goes through a bottoming process, the breadth or the percentage of stocks advancing will start to expand. And through a rally, one by one, securities join the rally in a healthy market until you get to the point where almost everything's working. Now, sadly, this is probably not the time to make your investments. You probably want to be making investments while breadth is narrow and expanding, because there's no bear market in history ever took place while breadth was expanding. And similarly, there's no bear market in history that ever took place before days or weeks or months of deteriorating breadth underneath the surface before eventually the leading stocks get hit, which often signals late in a decline. Okay, so with that concept in mind, we take that process and we apply it across all major asset classes, each major geographic region, and then 41 sectors and themes to try to identify which areas we want to focus our attention in. We'll only put new positions on in areas that are showing expanding breadth. Okay? When breadth is deteriorating, we get a little bit more defensive. We raise some cash. We tighten up the stops that we use. To the extent that new money comes in, we don't put new money to work. So let's talk about where we are today. Despite the fact that we have seen some choppiness in markets, breadth for all US equities continues to be firm. Now, I measure the percentage of stocks within the US universe that are in long-term uptrends, measured by a point and figure chart. It's called bullish percent. We take that same process and we apply it against other parts of the world, Europe, Asia, Latin America. All of those areas are showing expanding breadth. In other words, we got the wind at our back. And we have a series of short-term indicators that we use: percent of stocks with the 50-day, percent of stocks with the 150-day, percent of stocks with positive weekly price momentum. And there is some sloppiness in some of that short-term data, but the long-term indicators continue to be resilient. And that's important because as bad news comes, if those indicators are positive, it means the market is in a resilient situation. It can absorb bad news. So let's go back to the S&P chart and recognize that, yes, over the last 2 weeks, S&P sold off, low point yesterday, 5.6%. Let's look at some things underneath the surface that might be relevant. When I talk about markets having corrections or consolidations, it happens two ways. It happens in price, and that's the one we're also used to watching for. Price is moving lower. But it also happens in time, consolidation. Market has a rally and then goes sideways for a period of time. And usually it's a combination of both. So if I take the S&P 500 unweighted, in other words, every security worth the same, the S&P unweighted index has basically been consolidating since mid-April, 153 calendar days. So one of the things that we've been thinking about is that if corrections take place in time and in price, if you have an extended period of time, stocks go sideways, maybe you don't need as much price correction to take excess out. So we're going to examine that a little bit. Here's the Russell 2000. Russell 2000 has been in a range since February. Notice though, that each one of the more recent lows has been higher. This is the August low. This is the July low. Here's where we were yesterday and today, sitting right at the 200-day moving average. So that's the first thing. The average stock has been correcting and consolidating for months. This is the VXF ETF, which looks at all stocks in the US that are liquid and not in the S&P 500. And same thing, since February, consolidating sideways above long-term moving averages. So we have for sure had time. Now, the Nasdaq has been the strongest over the last few months, last couple of months, but also had a bit of a sharp correction yesterday and over the last few days. And we know that the Nasdaq 100 is dominated by the 5 biggest stocks in the market, which have been extremely resilient. Go back to my premise. The weaklings roll over first, and later in a decline, the strongest stocks get hit. So when the strong stocks are getting hit, it's not generally the beginning of anything. It's something that's later on in the process. If we look at the stats, and these are courtesy of my friend Chris Verone at Strategas in New York. If we take the S&P 500, we know the S&P at the worst point yesterday down 5.4%. The average stock down 12.5% from the highs. Nasdaq 100, the average stock down 13% from the highs. And the Russell 2000, the average stock down 28% from the highs. So that's price. So we've had time and we've had price. So the question is, are we getting there, or do we have a long way to go in this correction? So let's look at some things that maybe don't make sense given what's going on. If we are really concerned about contagion from Evergrande, the real estate company that is likely to be insolvent, and that was some kind of a Lehman moment. The one thing we've talked about over the last while is the US dollar is seen as a safe haven, a place to put money when you don't feel comfortable in risk assets. And despite the fact that we had, a day yesterday where the market was really sloppy, US dollar made no progress. It hasn't been able to get above this 93.5 level through the course of the summer, while stocks have been correcting, while we've been concerned about Delta, while we've been concerned about economic data missing estimates. And again, yesterday, unable to break out. And in fact, today, lower. Let's look at some other barometers of risk. Let's look at high beta stocks versus low beta, offensive versus defensive. High beta stocks have been relatively outperforming over the last 60 days. Consumer discretionary versus consumer staples, offensive versus defensive. Consumer discretionary stocks outperforming over the last 60 days. Transports versus utilities, offensive versus defensive, outperforming over the last 60 days. That might tell us that some of the concerns around growth and the impact of Delta variant may be in the market. The utility sector, which is seen to be a very defensive sector, a place you go if you want to hide from risk, the new lows are reaching levels that are showing weakness. On the other hand, when we look at energy new highs, the new highs in energy are expanding. So lots of new highs in energy, lots of new lows in utilities. That doesn't point to a market of investors who are becoming more defensive. Semiconductors versus software, offensive, more economically sensitive, versus subscription software, defensive. Relative performance over the last couple of months favors the semiconductors. That is not pointing to investors getting more cautious due to financial risk or economic risk. Now, here's the 10-year yield. We've talked over the last while that we think we've been going through a generational bottoming in interest rates, and that we are in a reflationary environment. And certainly yields moved from 1.5% to 1.7% off the bottom, and then they pulled back and corrected. they pulled back to 110 basis points. So this is August and September. And yesterday, despite some concern around Evergrande and around economic strength, no real move lower in yields or move higher in price. The bond market didn't react. In fact, while the US economic surprise data has been weakening over the last 3 months, yields have been very resilient, in fact, moving a little higher. Now, generally, yields move higher if the belief is there is economic growth in the offing. So bonds really not confirming a more defensive view. And if we look around the world, it's the same in Germany, Switzerland, Australia, and South Korea. So global bonds showing the same picture. Let's look at credit risk, or the excess return that bond investors, corporate bond investors, are looking for to take corporate risk. You can see that double B versus triple B spreads are hitting new lows. So in other words, if triple B spreads were widening out, this would be going the other way. So credit spreads continue to look very benign. So let's go back to the S&P chart again. We know that people have been concerned that the market has been as strong as it has been for several months, going back to last November. I saw an interesting analysis this weekend from another friend, Chris Cavaccio in the US, and he takes a look at the US through a different lens than we do. But one of the things he looks at is the behavior of moving averages. So for instance, 200-day moving average, 120-day moving average, 150-day moving average, 100-day moving average, 90, 80, 70, 60, and 50. And that's a smoothed average of price action. And when all of the lines are aligned, it means it's been a very steady uptrend. So when this happens, lots of people would say, wow, we must be prepared for a big correction. He went back and looked at all of the occasions the market made a low, took out the high, and rallied for an extended period. In this case, in 2021, 541 calendar days, starting with last spring. There's an occasion in 1950, 1963, 1995, 1955, 2013, 1959, 1984, and 2017. Now you'll notice that the moving averages were starting to roll over in 1984. But the question is, once the market had rallied like that, what happened next? In the next 107 calendar days, these were the returns for the market. Now, in the case of 1984, there was a 3% correction. 2 years out, 3 years out, and so on. But let's look at what kind of drawdowns investors dealt with in that circumstance, because lots of people are concerned about it. In the next 107 days, the worst pullback in the market, taking all of these occasions that all more or less look the same on a number of different factors, 3.5%, 4%, 2%, over 5 days, 19 days, 13 days, short-term, short pullbacks. Or 1 year drawdowns, the worst following year pullbacks in the market. You can see the worst one, 6.9%, one 8.1%. Again, 1984 being one of them, which was the weakest looking of the batch. If we take the ones that look most the same, 1955, 2021, and 1995, let's look at what happened here. 107 days out in 1953, markets up 13%, 1994, we're up 4%. 1 year, 27 and 18. The average is 6.2%, 15. And again, very muted pullbacks. A strong trend is a strong trend. It doesn't die easily. There's a reason why it's happening. It tends to be that the outlook is quite favorable. Let's look at things another way. The market has just gone through 7 straight months of rising tape. In other words, 7 positive months in a row with no pullbacks. This has happened 15 times since 1921. These were the forward returns, 1 month, 2 months, 3 months out. So on average, 1 month out, up 1.2%, 2 months out, 2.8%, 3 months out, 4.5%. You can see those numbers. These are the extents of the drawdowns, very small drawdowns. Now, these things don't mean that we can't have a more significant takedown in the market. But what it says is when the market is in a strong trend, there are shock absorbers built in that can absorb a lot of bad news. And when we see things that are happening that don't make sense, given the narrative, the concern that the economy is slowing and the most economically sensitive groups are behaving quite constructively, or the market is behaving resiliently and has positive breadth characteristics, these are things that cause us to think about what we should be doing with positioning. So with the S&P down 5.6%, it's possible that we've seen correction already. Of course, we still have some seasonality in front of us, and there's things to be concerned about. Frankly, we like the fact that there's a wall of worry. But at this point, we don't believe we are set up for a 10 or 15% correction, but we have to watch and be ready to make change as is required. I do think it's interesting that yesterday, on one bad day, the volume in the S&P 500 ETF, the SPDR, hasn't traded that much stock since going into the crisis in the beginning of COVID 2019. So MTUM is the ETF with higher momentum securities. And certainly it has pulled back here over the last couple of days. By no means is it broken. We've got a series of higher lows, things I'm watching for. I would like to see the indices hold above their August lows. We would like to see volatility remain contained. As it stands right now in our portfolios, we are significantly overweight financials and technology, the two groups that have been strongly leading. We are significantly underweight healthcare, consumer discretionary, also considerably underweight communication services, more defensive sectors. So consolidations and corrections serve a couple of purposes. One, they let the market take a breath. They let sentiment reset. The Investors Intelligence Survey shows bearishness. Only 22% of respondents in the most recent AAII survey were bullish. That's a positive. When we look at the fear greed index, it shows extreme fear, 5% off the highs. We saw a high volume trade yesterday. We saw 9 stocks down for every 1 stock up at 3 o'clock in the afternoon. That's a big sell-off. That's a washout sell-off. So we're going to watch volatility. So far, the move higher in volatility over the last 10 days is completely in line with all of the most recent small pullbacks in the market. What is different? Well, the bear market that we had going into COVID, unlikely that that is where we are, and the bear market we had in 2018. Quite different situations. So we're going to watch those. But here's one last piece of data that I think is relevant. The percentage of stocks in the S&P 500 that traded yesterday at a 20-day low, or a low for the last 20 days. 63% of stocks made a 20-day low. You can see in previous pullbacks, once you got below 50, you were getting pretty much there. So in uptrends, a reading north of 50% are generally found to be tradable lows. As Chris Ferrone says, we think it's a little early for this call, but we're likely in the ballpark. Interesting that utilities were 93% of stocks made 20-day lows. Materials made 86% of stocks made 20-day lows. So there's been consolidation, there's been correction. Certainly there can be more. We have to watch positions one by one. If our breadth models do turn down, we will get more defensive. But the returns going forward, when 20-day lows were above 50%, like they were yesterday on the close, in the next 20 days, the market was up on average 1.9% versus 0.7 for the average. Over the next 65 days, 5.8 versus 2.3, the average since 1972. And the next 125 days, 10.9% versus 4.4% for all observations. So the data continues to be fairly constructive. Now we're set up for the Fed tomorrow. There's going to be talk of tapering. That's something certainly that the market's going to care about. The Fed has been very transparent that there may well be an announcement that they're going to start to taper. I think it's more likely that that happens at their November meeting than at this meeting, but it's possible it happens now. We're all going to watch what happens with Evergrande. And Evergrande, you have to remember, is quite different than Lehman because the banks in China are an instrument of the government. They are an instrument to execute the government policy. And if the government says lend, they will backstop the lending. But we'll have to see where that goes. Financial conditions continue to be friendly, and we continue to be invested. If things get more difficult, we will not hesitate to get more defensive. And certainly there have been a few positions that we've trimmed out of portfolios, but in general, we continue to be fairly fully invested, and we'll see where we go over the next few days. I know that's a big picture overview today, not a lot on individual sectors, but I thought that that might be a useful topic for conversation. Pam, if there's any questions, certainly we can answer.
Thanks so much, Dave. One question here coming in on the Canadian dollar. It's seen a rise as Trudeau won a third term. Is that a path for economic support? And do you think that the Canadian dollar could be going higher here?
Yeah, frankly, I think that the election has very little to impact on our financial markets. The Canadian dollar is more driven by global factors than Canadian factors. Certainly, it's a consideration. But if we believe that more cyclical securities and there's more stronger global growth over time, then the Canadian dollar is more tied to that, is more likely to firm up because of strength in commodities and otherwise. Commodities are a mixed picture right now. We've had a little pullback in some. But frankly, the unweighted index of commodities continues to be very close to a high. Aluminum has been very strong. Nickel's been strong. Copper's pulled back a little, and iron ore has pulled back more, but that has less impact on Canadian market. Energy looks strong. So I would say follow crude and follow commodity prices, and probably Canadian dollar follows more so than the political climate.
Thank you, David. The next question, we'd love to hear your thoughts on cryptocurrency.
Sure. So this is a group that is going to continue to be volatile. In our view, our focus is really on just the biggest of the big. We're focused on Bitcoin and we're focused on Ether. Of the two, we are more interested in Ether because Ether is a platform. It's a technology platform. And the Ether blockchain has very broad uses. The price action is that it's pulled back recently. And I think that we were sitting around the lows today, about $2,800. So it looks like it's got some consolidation to do before it moves higher. It has been surprisingly correlated to other risk assets. So as other risk assets have pulled back, it's pulled back with it. But the uses and adoption is accelerating. So I would be surprised if a pullback lasted very long. But at this point, it's in consolidation.
Thank you, David. Well, that concludes the questions we received this afternoon. As always, I'd like to thank you for your time, David. I know that our viewers always appreciate your big picture view. And of course, as always, I'll leave you with the final word.
Well, there are days like yesterday where you scratch your head and you go back and go through the charts and see what makes sense and what doesn't. See if there are things that contradict your overriding stance on things. And as it is right now, I think that the picture continues to be that this is a market that's more likely going to finish the year quite strong. But in the very short run, we'll watch the developments as they take place. And if things change, the portfolios will change. But as it is right now, it's sort of steady as she goes. Thanks very much, Pam, and thanks everybody for tuning in.